This video is for everybody on the fence, not sure whether now's a good time to buy or sell. We examine the historical UK housing market as well as what's happening right now, applying leading indicators, not noise or headlines, real leading indicators to predict UK house prices so we can get out and stay out in front of the curve. First up, house price indices. I use a website called housepricecrash.co.uk because it covers all the major indices, giving us good market breadth as seen here with this snapshot. It also cites all the sources, so if we did want to dig into a particular report, it's all available quickly. A quick note on house prices, as you've probably seen by now, they're all different. They all state a different average price, bar the land registry and the ONS, which I'll come on to, and whilst they're all released within the same month, they can cover different periods. This can get confusing, so I'm just going to quickly touch on each one so everyone's on the same page and examine what's happened in that reported month. Okay, let's start with the most timely, which is Rightmove. This index is kind of the odd one out as it tracks asking prices and it's not released at the end of the month reporting data for the previous month. It's actually normally released midway through a month, but still includes data for the previous month, just not calendar month. So according to Rightmove, asking prices in the UK are just shy of 370 grand, up 9.3% on the year and have increased 0.4% from the previous month. The next report to be released is from Nationwide, and this is typically on or around the last day of the month. Now, Nationwide doesn't use asking prices like Rightmove, it uses data from its own mortgage lending to give us an average asking price of 271,000 and change, up 10.7% year on year, and up 0.3% from May to June. Next up is Halifax reporting June data. It's the longest running house price index of the lot, and like Nationwide, it uses its own mortgage lending data to give us an average asking price of just under 295k, up 13% year on year and 1.8% month on month. You'll note that this is the index showing the highest level of year on year growth. Next up is the most authoritative, as you'd expect being the government, and is often just referred to as official figures, and that's the Land Registry. In fact, the ONS and the Land Registry both produce their reports on the same day, but there are a few big things to note. Firstly, the ONS uses the Land Registry data, however, you'll see some discrepancies. This is just because the ONS rounds to the nearest thousand. You'll also see both here state the same year-over-year growth at 12.8%, but differ with the month-on-month figure, 0.9% to 1.2%. This is simply that one is seasonally adjusted and the other isn't. The last point to note is that the Land Registry uses sold prices to compile its index, and so given that it has access to all the data for all recorded transaction, this is just another reason why it's often the most quoted. But the issue with compiling all that data takes time, and this makes the report the most lagging at 2 months behind. So for example, the report released in August will contain data from June. So shown here we can see the July report is actually reporting data for May. So as you've probably concluded, all this data is great, but it's all lagging, meaning it's reporting what's already happened. So if you sat here thinking, how can we attempt to predict prices because you're either looking to buy or sell, stay with me because that's the bulk of the video. Rightmove is the most timely house price index, as we've said, that reports changes in asking prices, and for that reason it can often be ignored, but I don't think it should be. Because it's very timely, meaning it's released before any other house price index, and it covers around 95% of all properties sold, we can infer a lot from it. For example, can we use it to predict the land registry data, which as previously explained uses sold prices, but is seen as the most authoritative? In essence, could we use it to see if house prices have already started to crash in the official land registry data? Here I've plotted the month-on-month data from both Rightmove and the Land Registry over the last 5 years. Taking a look at the graph, you can see the Rightmove data shown in the blue colour with the bars and the Land Registry data shown in red in the line graph. Let's have a look at this on the full screen. We can see a very loose relationship in some months where the land registry data is positive and the Rightmove data is actually negative and vice versa. In fact, where one data set is positive and the other is negative. This actually happens 28 times out of 59 data points, so nearly 50% of the time. So remember, we're trying to infer a correlation between the latest Rightmove data to the lagging land registry data in an attempt to predict it. So saying that nearly 50% of the time one is positive and the other is negative isn't particularly helpful, as you get the same odds from flipping a coin. We're going to have to dig a little bit deeper, and digging deeper into the data and dragging out how many times the land registry data is negative when the Rightmove data shows a positive change is much more revealing. And we can do this because we already have the latest Rightmove data. It's positive. So when the month-on-month change from Rightmove is positive, the land registry data for that same month is only negative 22% of times. Or we can flip that around and say that 78% of times when the Rightmove data is positive, the land registry data will be as well. So to conclude then, we can say that there's roughly a 78% chance for each month that the land registry data, when released, will show a positive month-on-month change, meaning house prices will have increased. So prices to date probably haven't started to crash. Does this fit with our narrative from the other house price indices? Yes, it does. From both Nationwide Building Society and the Halifax data we saw earlier, they're still reporting growth for those months, but the rate of year-on-year growth is slowing. So prices are currently cooling but haven't yet crashed. Now that's from our data going back 5 years. For anyone with a keen ear will have heard I said 59 data points, one for each month over the last 5 years. It should be 60, calculated as 12 months in a year times 5 years. That's simply because Rightmove missed reporting data during COVID. Why is any of this relevant? Because we've still used lagging data, even looking at the Rightmove figures. It's still reporting what's already happened. Well, it's important to put some colour into what's happening right now so that we have an up-to-date backstory and we can use that to map trends. As we go on, we can use this lagging and coincidental data to confirm or deny our biases from leading indicators. And at this stage, that's all we're doing. We're formulating a bias. But that is what we need to do. We need to look at leading indicators to attempt to predict moves in house prices to get out in front of the curve, helping us to decide whether now could be a good time to buy or sell. And to do that, we've got a few leading indicators to explore. The first leading indicator we're going to jump straight into is mortgage approvals. The Bank of England produces a report each month, the Money and Credit Statistical Release, and within that is a component called mortgage approvals. Mortgage approvals are an indicator of future borrowing for home purchases. The more mortgage approvals, the higher the potential demand for home purchases there is, and vice versa. As demand for mortgage approvals falls, so does future demand, and therefore prices will follow. Or do they? Let's test this theory to see what happens when we graph mortgage approvals and then overlay annual percentage changes in UK property prices. There is clearly a correlation, but it looks slightly offset. And this is because, remember, approvals should lead prices. Now, we could lag this by a number of months to show a greater visual correlation, but I'm not going to, so it's easier to highlight the data. For example, in the last crash, approvals topped out in around October of 2006, with percentage change in prices peaking in June 2007 and nominal prices peaking in September of 2007, so a full 11 months after approvals actually peaked. Then we can see approvals bottoming out in November of 2008, with prices bottoming out 5 months after that in March of 2009. In both examples, we can see approvals actually leading prices, but we have more examples. Approvals increase after the GFC and peak in December 2009, with prices peaking in the summer of 2010. Again, another long run up in prices, with approvals peaking in January of 2014 and prices increasing year over year in percentage terms all of 2014 up until they peak in October. In fact, then we've two mini correlated peaks and troughs before a flat period of mortgage approvals and year on year growth really slowing. This flat period with no growth in lending leads to a decline in year-on-year prices in percentage terms until the pandemic hits, and then, of course, all that changes. In November of 2020, we see an explosion in mortgage approvals, figures over 100,000, which we haven't really seen since the peak of the last cycle. This certainly got my ears pricked. Since that peak in approvals, we've seen prices continue to remain strong, underpinned by low supply of properties for sale. So yes, approvals will generally lead future lending, but when supply is constricted, it can lead to higher prices. But it could, if supply was plentiful, lead to lower prices. We can't really view future demand through mortgage approvals in isolation. We have to look at supply too. Now, most mainstream media will comment that if approvals are down month on month, quarter on quarter, or year on year, then prices will follow. Yes, but what about if supply reduces by the same amount? Then there's been no change to the ratio between approvals and supply. After all, you're unlikely to go for a mortgage approval as they're time sensitive if there are no houses to buy. So to summarize, approvals are back down around that 10-year average, but prices are yet to fall, but they are showing signs of slowing. To find out what's going on, we need to examine supply. And one of the best places to do that is with the latest RICS market survey. Goldman Sachs calls it the best short-term lead indicator of house prices and activity. And if that wasn't enough, the Financial Times calls it one of the most reliable guides to movements in house prices. So let's dig into this. Firstly, what is it? The RICS UK Residential Market Survey is a monthly survey of chartered surveyors who operate in the residential sales and lettings market. You can see the first headline we see, new buyer inquiries indicator moves further into negative territory. Now this should start to reconfirm the bias that we're creating from the numbers that we've seen so far in mortgage approvals. And in fact, if we scroll down each month, there's a report and graphs associated to those figures, and we can see here new buyer inquiries for the last month. Yes, it has fallen into negative territory, but there are plenty of times over the last 22 years where this has happened. We just need to be mindful. So if we scroll a little bit further down in this report, which was released in July but actually covers June data, we're given national price expectations for both 3 and 12 months forward looking. Both the 3 and the 12-month price expectations from surveyors themselves are bleak, with prices expected to slow, again reconfirming our bias. But we do just need to be careful how we interpret these readings, as net balance is equal to the proportion of respondents reporting a rise in prices minus those reporting a fall. So if 40% reported a rise and 10% reported a fall, the net balance would of course be 30%. Now, because whilst new buyer inquiries, i.e. forward demand, is net negative, price expectations are still net positive for both 3 and 12 months forward, as more respondents are reporting increases than decreases overall, but the breadth of those reporting increases is falling sharply. Supply then. What's happening across the UK? Well, back to the top of this report, and RICS state new instructions remain more or less flat. So if new supply is flat, does this mean prices will continue to remain firm? Well, not necessarily, as demand is now falling. So even if supply does remain flat, but demand drops, the supply imbalance could start to unwind. And that's what I think chartered surveyors are alluding to when they predict prices will slow over the coming few months. And actually, just quickly, there is another very rudimental way to see the number of listed properties for sale on Rightmove, which again captures around 95% of the UK market. Listing numbers are up around 30% since January and around 3 to 4% in the month of July alone. Now, this is a rough and ready way to look at things, as we can't adjust for things such as seasonality. But what we can say is the number of listings on Rightmove bottomed in January of this year, and they've been on the rise since. Rightmove also states some stats for supply too, saying the number of new sellers coming to market is up 13% compared to this time last year, although available stock is still down 40% on June's 2019 levels, which will help to, of course, underpin prices. Okay, let's just have a quick sit rep and run through what's been said so far. What we do know is very strong demand and low supply has led to nominal price increases, but we are starting to see data supporting the supply-demand imbalance beginning to unwind or possibly even reverse. Demand is falling, shown from the approvals data. New buyer inquiries from RICS is falling further negative, and Rightmove says that whilst demand is elevated compared to 2019, it's actually down 7% compared to this time last year. On to supply. Well, again from this report, RICS said supply is flat, but it's up 13% according to Rightmove. House prices, therefore, I think are in no danger of crashing in a month, but these figures are still tentative. But if this starts to unwind faster than expected, we could see much bigger falls in prices than mainstream media is expecting. We're going to need to track what's going on here very closely, so I'm going to put this on our dashboard of monthly things to deep dive into, as this could very much be the pin of the housing market. Moving on then. So if mortgage approvals drive future demand for lending and that in turn affects prices, what drives mortgage approvals, if anything? Well, I guess you can argue a few things, but mainly sentiment does. If you think it's a good time to buy or sell a house, you probably will. And this brings us nicely onto our next leading indicator, the UK Confidence Index from GfK. The Consumer Confidence Barometer has been running since 1974, and it's essentially just a survey asking 2,000 people in the month of July a series of questions from the state of their personal finances to savings, etc., etc. So if we click down here and look at the overall aggregate barometer, we can see that currently in the UK, it's exceptionally low. In fact, it's very low. It's lower than the '08 GFC, and actually it's lower than COVID. If you remember, during the '08 GFC, we obviously had job losses, we had a long recession, we had tens of thousands of home repossessions, and it's actually lower now than it was then. What's also interesting to note is that this bottomed in July 2008 and house prices bottomed in March 2009, a full 8 months later. We can then see it peaking again after the GFC in around October 2009, but house prices year on year didn't peak in percentage terms until around April 2010, another 6 months after. The next slide down in this report shows the personal financial situation of households. They were asked two questions. How has the financial situation of your household changed over the last 12 months? And how do you expect the financial position of your household to change over the next 12 months, i.e. forward looking? The answers are scored and the answers are following. Got a lot better at 1, got a little better, 0.5, stayed the same, 0, got a little worse, negative 0.5, and got a lot worse is scored -1. You then aggregate up the answers and you get the following chart. You can see this blue line, which is the last 12 months, is about as low as it's ever been. But what's even more worrying is the forward-looking personal financial situation of households over the next 12 months is expected to stress even more. Moving on down then to the last slide in the GfK Consumer Confidence Barometer, we can see two things charted here. One is the personal finances over the next 12 months, and the second is the general economic situation over the next 12 months. So this is sentiment regarding personal finances forward looking and sentiment regarding the economy again forward looking. First of all, taking this red line here, we can see the sentiment regarding the economic situation over the next 12 months is pretty much at an all-time low, just a little bit lower than the '08 GFC. If we take the personal finances, they are most definitely at an all-time low, much, much lower than the 2008 crash. Well, you might be thinking, so what? Why does any of this matter? How can we apply it to the housing market? Well, let's just take a look here, for instance. We can see this peak in June, July 2007, and we know from previous segments of the video that the housing market peaked in September 2007. We can also look down here at this trough, July 2008, and we know that house prices didn't trough until March 2009. So we can clearly see this leading, in this example, leading house prices. There's one other bit I want to draw your attention to, which is this peak here. It's around the summer of 2014, June or July 2014. And if you remember back, in fact, we can take a look in our sheet here. This is the summer 2014. We kind of hit these peaks. And then after that, we see this gradual decline, this decrease in year over year in percentage terms of house prices all the way down into pre-COVID. Okay, the GfK Consumer Confidence Barometer isn't the only one we can use. We can use other consumer sentiment surveys to actually cross-reference what we're seeing here and back up in order to confirm or deny the bias that we've been building throughout this video. A good example of that is the PwC Consumer Sentiment Survey. PwC are one of the big four accountancy firms in the UK. Although the consumer sentiment doesn't give us the data as far back as the GfK Consumer Sentiment Survey, it does break it down by age group, which is interesting to see. There's 2 points to note here, which is the COVID lows, which you can see now, 3 age groups out of the 6 are below those COVID sentiment lows. But what's also interesting is this gradual decline from the start of the year up until now. Now, we've avoided the subject up until now, but of course, what is stressing households and personal finances? And that's the elephant in the room, it's inflation. We're going to jump into inflation, unpack it, see what it's doing to personal finances, see what it's doing to wages in real terms, and see what it's doing to house prices, again, in real terms. Anything we've seen up till now has been nominal. Okay, we're now back in our spreadsheets, and in front of you, you can see the total seasonally adjusted real average weekly earnings across the UK. And by real, we simply mean the nominal adjusted for inflation. And the source of this data is the Office for National Statistics. It's freely available. Anyone can download it. In fact, anything in this video that you've seen so far is free to download. So what's happened to real average weekly earnings since the year 2000? Well, you can see this run up in real wages all the way up, peaking around the same time as the GFC before crashing back down, hitting lows around the middle of 2014 before starting to run up again, slight dip at the start of the pandemic before an increase and a plateau for the last couple of years, where they've now started to just slowly tick down. In fact, real wages now are about the same as they were in the middle of 2019, and actually as far back as the same as 2007. So my question is, do falling real wages support a growing housing market? I would immediately probably answer that question and say, well, no, probably not. How could they? So to unpack that, we need to have a look at what happened to house prices over the same period. Actually, we're going to look at real house prices. So here we have real UK house prices, real meaning adjusted for inflation. The source is Nationwide Building Society, and if you remember back to the start of the video, Nationwide derived their house price index from their own mortgage lending data. But there is a caveat. These are house prices adjusted for RPI, retail price inflation, not the current measure of inflation used by the government, which is CPI. In fact, RPI was the old measure, the old official measure used by the government. So let's just unpack what's going on here, because we can see various market cycles, various peaks and troughs here. But I just want to draw your attention once again to the GFC. This peak here in real house prices, followed by recession, etc., leading to falling real UK house prices, bottoming out around the end of 2013, 2014. Where does this period look familiar from? Well, if we click back and have a look at real earnings, we can see this decline here from 2008 to around 2014. So to answer that question, do falling real average weekly earnings across the UK support a growing housing market in terms of price? Well, to answer that simply, last time, no, it didn't. Now, the increase in real wages will have been a big factor in this run up in real house prices. But was it the only factor? I'm coming on to interest rates, but I do just want to touch on the bank rate. This is the interest rate set by the Bank of England, and largely throughout the period in question, it was flat at 0.5%, only getting cut by 0.25% or 25 basis points in 2016, where it remained for much of 2017 as well. Okay, we've got to move on to interest rates. This is the big topic now, with the Bank of England slowly increasing bank rate. We've seen the ECB move just this month with a 50 basis point and 0.5% increase in their interest rates. And of course, we've seen the Fed yet again really striving to get out in front of the inflation curve with another 75 basis point hike. So you can see here rates, and these are UK household mortgage rates in percentage. The source here is the BOE. You can see how rates have come down steadily from around 2012 to around at the start of COVID, where we saw that slight hump, and then we saw rates being cut from the Bank of England. So that means rates going into UK households would also decline. But then around this time, we saw the Bank of England move rates up from 0.1% and offer some, I guess, forward guidance saying that rates could actually increase further. So we can see rates currently sitting around 3%, but if we want to have a look on an individual basis, as that's a little bit crowded, I've produced another bar chart here with the latest data June denoted in red, and you can see that in percentage terms, it's sat all around that 3% mark. I've also included September 21 data as a reference point, and you can see visually how much the interest rates have increased since then. A point to bear in mind was the Bank of England first hiked, I guess, in December of 21. So that first bank rate hike for a long time happened in December 21, when of course that meant lenders, high street lenders, increased their rates too, and that fed through into household mortgages. So to pose the same question then, but applying it to rates, is a rising rate environment supportive of house price growth or not? Well, there has been times throughout history when rising rates has meant the property market has had a boom. But think about it like this: if rates continue to rise, all that's doing is chipping away at the disposable net incomes of households. So, what are inflation expectations? Because from that, we can potentially derive a central bank policy for setting bank rate, and therefore we can predict interest rates or attempt to. Because as you can see here with the blue bars, these were the interest rates being paid for mortgages when bank rate was just 0.1%. However, in the red bars, we can see the latest data that interest rates being paid when bank rate was 1 to 1.25%. The Bank of England actually hiked bank rate midway through June. So if the Bank of England continues to hike bank rate from its current 1.25% to around 2 or 2.5%, we could see mortgage interest rates doubling from here to between maybe 4 and 6%. Again, another downward pressure on disposable net incomes. So back to my initial question, what are inflation expectations? Well, to have a look at that, we can go back over to the Bank of England website and we can look at what they call the UK instantaneous implied inflation forward curve. Now, I am not a macro fixed income expert. This is not my background. However, what we're attempting to do here is look at this curve to potentially try and predict where inflation is going or where the market thinks inflation is going in an attempt to predict Bank of England policy regarding that base rate, which of course affects interest rates into households, which affects incomes, because we know income is a big part of driving the housing market. So you can see the curve here, in fact, two curves, I'll come on to that. And the way this is derived, the bank uses something called the Fisher relationship or the Fisher effect. But essentially, you can think of this as being calculated as the difference of instantaneous nominal forward rates and instantaneous real forward rates. So what can we imply from this? Well, we can say forward implied inflation rates can be interpreted as the rate of inflation expected to rule over a given period which begins at some date in the future. So we can see here the two curves actually falling at the front end, looking out probably 2.5 years, we can expect that inflation rate to start to decline. In the US, Jerome Powell, Fed chair, is actually hiking rates very, very aggressively to try and get out in front of the curve. Well, we're in the UK. What does that mean? Who cares? There's a saying that what happens in the US happens in the UK a little bit later, or the US sneezes and the UK catches a cold. So let's go over, explore house prices in the US and compare them to the UK in order to see if we can predict what's happening in the US now, when and if it might come to the UK. There's been lots of columns in the mainstream media this month about the deteriorating state of the US housing market. In fact, home prices in Canada are also under serious strain, and home prices in Australia continue to stress as well. But the US housing market isn't the UK housing market, so who cares? Well, after plotting both the US and UK house price indices, we can see from the graph a strong correlation, which fits with our bias actually, as the UK and US tend to follow similar monetary and fiscal policies. What's very interesting to examine is the last house price crash, which occurred as a result of the GFC in 2008. You can see that UK house prices peaked after the US and they actually didn't fall as far. However, both bottomed around the same time. So using the data from the '08 crash, looking peak to peak, we can see that US home prices actually led the UK by around 12 to 14 months. Meaning, and just using one example isn't obviously as accurate as using multiple examples, that we can expect potentially what's happening in the US to hit the UK by around next spring or summer. And that's pretty much it, guys, for this video. Thank you so much for watching. Thank you so much for listening. Just to recap then, our biases formulated from the data that we've seen throughout this video. We've seen supply demand possibly starting to unwind. Certainly supply is slowly increasing with demand, we know, falling. Inflationary pressures, very high inflationary pressures, potential for higher bank rate hikes from the BOE, and very low, actually historically low sentiment. So, what does all this mean for house prices, or what could this mean for house prices? The saying, beware of Greeks bearing gifts, will definitely be even more wary of people on the internet making predictions. I've got three scenarios here that I think could play out. One, house prices track much higher. Two, they trade sideways, really with little or no interest, with that supply demand imbalance staying stuck as it is. Or the third option, I see a correction like we've seen throughout lots and lots of market cycles before. Remember, the housing market is a market just like the stock market. I feel that pressures, those downward pressures, could be too much for the property market and it will reflect in prices. However, this is a completely fluid situation. We've already started to understand the pin, that what's underpinning prices is the supply demand. Everything we've mentioned in this video is a fluid situation. It's not static, it changes daily, weekly, monthly. So as we run through these videos on a monthly basis, we're going to unpack everything that we're seeing from our leading indicators, confirm or deny our biases that we've built, change them around. It's a completely fluid situation and one that's going to change with government policy, interest rates, inflation expectations, and of course the crux at the minute, which is supply and demand. The next video I'm going to be working on is actually going to be unpacking or deep diving property by property type. Throughout most of this video, in fact, nearly all of it, we've been talking about average properties across the UK. Well, average properties are made up of detached houses, semi-detached houses, terraced houses, and flats and maisonettes. And you can clearly see as we go back to the last cycle, '06 onwards, all the way through, very tightly grouped prices or percentage change year over year by property type. And we get to COVID, and then we see this large dislocation where the race for space, the so-called race for space, saw detached house prices shoot up, followed by semi-detached and terraced houses, with flats being sold off. So the question I'm posing is, if detached and semi-detached houses have been ran up so much during COVID, are they at higher risk of correction than other property types? And are they at a higher risk of correction, not just the average across the UK, but in certain regions of the UK as well? If we scroll down, we can see some more price dislocation as I see it, which is the difference between new build prices and existing properties. We can see them tracking each other and correlating throughout the last 14 or so years. And then we get again to January-ish of this year, late 2021, where we see this huge price imbalance. Again, are new builds at risk of correction? What does this mean for people potentially looking at buying new builds? Thank you so much for watching, and I'll see you in the next video.